Hello everyone and welcome back. So in the last video I've explained about the concept of our project today, and today we're going to start on our simple calculations. So in each column we're going to be calculating our mean return. So in terms of mean return, we want to see how much return do we get compared to the last month, since we're comparing data month by month. So we don't have any data here. I will keep this empty because we don't have data from 2010 December. So we don't know how much mean return can we get between this December 2010 and January 2011. So we'll start right away from the February 2010. So what we do is we take an equal sign and we get adjusted closing price. We minus the previous price. So now we bracket them up. We bracket and we divide them by the original price. So I hope this concept is pretty easy. If you learn about percentages, this is basically a concept on percentages, which you take the data today minus data last month and divide by the data last month, and you can see it's a 3.47% growth of our return. Now we just drag it down, drag it to our last cell, and it's pretty fast. We get 3.47, and from February to March we get a decrease of 0.44%, then we get increase again, decrease. We got an 11.3 increase here. So this is our mean return on our stock market. Hope it's pretty easy for you guys, and make it smaller. And now we do the same thing for the bond market. So we do for February 2011, equal sign, adjust close, F3 minus F2, and now we make a division, divide by F2, easy. We get a 1.03%. Now what you just do is you see this little rectangle, or little square right here, and you just put your cursor here and you actually just drag it down, and it will drag for you, and that's it. Okay, so if we take a raw look here, you can see the bond market have a less risk and higher return. So in case you don't know about what is a bond is actually a kind of a traded financial instrument that government, or especially government or companies, issue, and basically it means they borrow money from you, that is a principal sum, and they're going to give you a certain return, which we call as a coupon. So for example, if you borrow $1,000 to the bank, and the bank may pay you maybe 10%, maybe 5% each year for its coupon. So that is about the bond. And stock is not issued by, it's also issued by companies, but not by the government commonly. And it is not about borrow money, although the money is also used for the company in finance, but you actually can sell your stock to other shareholders. It can be a kind of a cycle around, but it's not directly give you money for use for the company. So what happens is, for the bond market, there's a less risk involved, but the return is overall also lesser. As you can see, it's fluctuated between 0 and I think the average about 2 and 3%, or even 1 point something percent. And here you can see sometimes it can go up to even 4.99, it can go up to 11, but you can see it can drop, it can go up to 5, but it can also drop to 6%, and it can be highly risky. But so that's why we try to diversify our portfolio to combine maybe a percentage of a stock, and a percentage of a bond to reduce our risk and leverage our return. Okay, so now we have completed our main return, and now guys, let's now go to the third sheet, and in the next video we'll be doing our calculations on our third sheet to gradually help us to build a model. I'll see you in the next video.